My name is Brianna. My presentation is called Top Stock. I'm looking at the Dow Jones and using that as my investment index, and from those 30 stock, I'll present the best one as an investment. I'll look at each stock's performance over the last 5 years as their competitive performance. My first step was to rank each stock according to the highest ROE. And I made my decision based on the stock that provided the highest return on equity over the last 5 years. And those top 5 stocks are Boeing, IBM, Microsoft, McDonald's, and Caterpillar. By taking the standard deviation of their ROE over the last 5 years, I was able to apply an efficient frontier. Only the top 4 stocks are on here because Caterpillar was phased out by McDonald's, which was able to provide a higher return for less risk. Next, I was able to eliminate Microsoft because it provides barely any additional return for a considerable amount of risk. The actual amount of return per unit of risk is less than 1. It's 0.85. Next, I was able to eliminate Boeing, which is here, because compared to the other stock, it really just provides, you have to take on way more risk than I'm comfortable with. So that leaves McDonald's and IBM for my top 2 stocks to decide from. So I looked at their ROE over the last 5 years, and IBM has indeed been able to provide a greater return on equity consistently, a much greater return than McDonald's. However, their ROE has been relatively volatile. It hasn't been consistent. On the other hand, McDonald's ROE has been about the same for the last 5 years. So in choosing to invest in McDonald's rather than IBM, you might be sacrificing a bit of return, but you would be gaining an amount of certainty that some people might consider to be more valuable. In analyzing the components of ROE for these 2 companies, I took the average of each ratio over the last 5 years: interest burden, EBIT margin, total asset turnover, and equity multiplier. And compared to McDonald's, IBM has a considerable amount of leverage. And compared to IBM, McDonald's has been able to do a better job of maintaining more of their revenues after paying their bills. So looking at the 3 most important ratios in the DuPont analysis more closely, we can see that the largest gap between IBM and McDonald's is here in leverage. McDonald's has pretty much been consistent in the amount of debt that they take on. However, IBM has not been quite as consistent. And they have taken on, in some years, 3 times as much debt as McDonald's. They have been able to provide a higher return on their assets, has been able to use them more efficiently, but not by much. And that makes sense because IBM has inventory that they sell. They have revenue-producing assets that McDonald's doesn't really have. On the other hand, McDonald's management has been much more efficient than IBM's. They have consistently been able to keep a greater percentage of their profits after paying their bills. And additionally, if McDonald's did want to raise their ROE, they could just borrow more. They have that advantage. On the other hand, IBM is already borrowing a whole lot. And finding ways to cut costs is a lot more challenging than just issuing more debt. So then I looked at the liquidity of these 2 companies. McDonald's has been more liquid on average than IBM over the last 5 years. Their average current ratio is 1.34 compared to McDonald's, which is 1.2. They both have the ability to satisfy all of their current obligations and have additional current assets left over, but when it comes down to it, McDonald's would have an easier time weathering the storm than IBM. There's a much bigger drop from the current ratio to the quick ratio for IBM, which makes sense because they have inventory, more inventory. And an even bigger drop from the quick ratio to the cash ratio for IBM because they have more receivables. So if there was a time when, like if the economy fell into a recession, they're more dependent on people paying them back than McDonald's is, making them more risky. So then I looked at the relative volatility and the beta of these two stocks. The relative volatility of IBM to the Dow Jones is 1.31 compared to McDonald's, which is 0.9. So IBM is actually more volatile than the Dow, and McDonald's is less volatile. And I looked at their betas, and IBM has a beta of 0.996, and McDonald's has a beta of 0.566. So when adding these stocks to a portfolio, beta would increase your total risk of your portfolio much more than McDonald's. And looking at how these companies satisfy their debtors and their stockholders, McDonald's has been doing a better job of keeping them happy. They've provided above and beyond the return that investors and creditors both require of them consistently for the last 5 years, when IBM has not been able to do that. And in the years that it has been able to do that, it hasn't outperformed the McDonald's. And their economic value added for the past 5 years is listed in the table above. So looking at their market ratios, IBM has shown consistently higher multiples than McDonald's, which is to be expected because it's a technology stock and they tend to have relatively high market value ratios. But you can see that the trend of their ratios is not as consistent. The trend of IBM's ratios is not as consistent as McDonald's. Using the dividend discount model and EPS times the price to earnings ratio, I determined that McDonald's stock is currently undervalued. An investor who purchases this stock will be able to enjoy capital gains when the market reprices this stock correctly. The stock is currently selling for $102 when a dividend discount model from Bloomberg values it at $156. And their target price using EPS times the PE ratio puts their stock at 108. So this would be a good buy, especially since the stock is definitely going to go up when the market prices it correctly. Last, I looked at the supply chain of McDonald's. It's a very low risk. They have 32 suppliers, and no one supplier has an effect on more than 10% of their revenue, and they sell directly to the general public. So my recommendation is to buy McDonald's over any other security in the Dow because it provides one of the highest returns, the fourth highest return in the index, and is relatively low risk.